let's get started because we got a lot to cover tonight, guys. Just want to make sure everyone's up to speed. Welcome back. Happy late Thanksgiving. Hopefully everyone had a good one. Let's just talk where we are and what we're doing today and what we're doing next week. So, you guys know what is authority, some general tax policy issues. You know what is income, you know what is exempt. You can compute gains and losses. Fingers crossed. You know the character of the income and what is capital asset versus non-capital asset. You can tell me, I hope you can, who would be taxed. We spent quite a bit of time talking about what is deductible, and we looked at around package code section 162, A1, 2, and 3. We know it's complemented or considered, got to consider personal expenses under 262, capitalization under 263, some of the limitations under code section 274. We then turned our attention beyond business deductions into investment expenses. Memorialized in code section 212. You know that code section 212 expenses have to be, may have to be capitalized under 263. And we saw the limitations, at least under, for now, under code section, new code section 67G that applies that miscellaneous itemized deductions aren't going to be deductible to the year 2026. And then we turned our attention to beginning about timing issues. Because we don't have the luxury of time tonight, because in terms of material, tonight is class 13, our final class is class 14, which is next week. So our next week is our finale here. And I will be around all week. I'll make that announcement. I know it's raining out. I know it's not easy to navigate the streets of Newark right now, but I'll make clear. So next week, we'll be hopefully all back here for the exam. So I have to make sure we get through chapter 19. Now, in terms of chapter 19, I think we left off with just a general overview of how this chapter is organized. And chapter 19 has 4 different quadrants, right? And we did the cash, accrual, income, and deduction, right? And we said that this is an important chapter because in general, taxpayers would prefer to defer income and accelerate deductions. The exact converse is true with respect to the IRS. They would prefer to accelerate income and defer deductions. So the taxpayers in the IRS have opposing agendas in general. And we talked again just in general terms of where some of these rules are found. Code section 441 till code section 450 talks about general precepts of that taxpayers are generally on a calendar year. If you want to open up to code section 441, can't hurt. So 441 talks about computing taxable income generally on a calendar or fiscal year. A fiscal year is any year other than a calendar year. 442 talks about change of annual accounting periods. You cannot willy-nilly change your accounting period. Code section 443 discusses a stub period where sometimes or return is for less than 12 months. So, Code Section 446 describes general methods of accounting. 446A says taxable income shall be computed under a method of accounting on the basis of which the taxpayer regularly computes his income, keeping his books. And it discusses the permissible methods. Code Section 448 discusses the limitations on using the cash method. As we discussed, that cash is less accurate than the accrual method. So there's limitations on who can use the cash method. These are spelled out in Code Section 448. And we said that the big code section for our purposes, Code Section 451 for inclusion issues, and Code Section 461 for deduction issues, okay? We're going to have that 451 for inclusion issues, 461 with respect to deduction issues. And as you know, having dealt with this for the last 2.5, 3 months, we're going to talk about the general rules, and then we're going to talk about exceptions. All right. So, with no further ado, beginning on page 591, talk about the cash receipts and disbursements. So we're going to go through the cash method. Any questions? Logistically, substantively, anything you're stuck on? Anyone stuck on? Anywhere, everyone's good? All right. So, I believe we looked at the collar case last class, right? At the very end of class, we had a taxpayer who got a payment on December 31st. It wasn't a cash payment. It was a bank note. The question was, when did this taxpayer have to report? When received the check on December 31st after all the banks closed, or could it be reported the following year? And the question is again, year 1 or year 2? Remember, Paul? Which year? Year 1 or year 2? Year 1, right? Why? What was the theory?
Because it was like he had received cash.
Cash equivalent, right? Okay. So it was cash equivalent, and as such, taxpayer had to report it. Okay? And we're just going to go through each one of these quadrants. Again, that's how the chapter is organized, guys. Williams v. Commissioner. Somewhat simple fact pattern. Elizabeth, you have a chance to read it? I'm sorry?
The summary. I have a summary.
You want to tell us the summary?
So it says that they were unable to pay promissory note. They received the payment much later, like 3 years later, for $6,666, and the commission said that he should have been reported on 1951.
Right, so the question again is year 1 or year 2, right?
Yeah.
And here the taxpayer gets something that is a unsecured, non-interest-bearing promissory note in year 1, and the commissioner says taxable in year 1, right?
Yes.
Taxpayer said no, taxable year 2. Who wins and why?
Actually, the taxpayer won.
Why?
Because they didn't really have the income in 51, they didn't really receive the money. And it was a 240-day payable.
Well, that's true. You remember in the collar case, the first case, they didn't receive cash. So that can't be the metric upon which you evaluate this. So why compare and contrast? What was the difference between this case versus, right?
promissory note is waived?
It's a promissory note, and the court labels that.
It's not, they said it wasn't directly income.
Well, they used a phraseology that was merely evidence of indebtedness. So, Elizabeth, if I pay you with a note, an IOU, Solid owes you $7,166 payable next year. Is that intended to be a cash equivalent, or is that just evidencing the fact I owe you money? And Elizabeth, you tried to sell Solid's promissory note 10 or 15 times. You can't. No one's going to pay you anything, right? You have income. You feel like you have income that year.
If I received a note that I will receive, doesn't mean that I have received.
Right. All right. So that's what this court says. This is not a cash equivalent. Not a cash equivalent. It's mere evidence of indebtedness. All right? Mere evidence of indebtedness does not constitute income. What do you think about Cowden? Can you just read it? And Andrew, since you just got your placard to get the honors, you have a chance to read it?
I reviewed it, but I'm not confident.
Sure, Jason? Right there, you get. All right, you shaking your Sarah? Kathy? Vikram? Talk to me.
So, Frank Cowden and his wife, they leased mineral rights
Right?
to Stand Oil in exchange for bonus for advanced royalty payments.
Right?
And so, but the payments were not conditioned in production, but were deferred over a period of years.
Right?
So, and Cowden decided the payments to them for face value.
So they essentially sell royalty rights for payments. They're going to be paid next year in year 3, right? And it's going to be about $500,000. And by the way, these taxpayers are pretty aggressive because how would you treat the receipt of royalty payments generally, guys? What would be the character of income, royalty payments generally? Ordinary income, right? I have wow on my left-hand column because at the bottom it says the taxpayers report the amounts received by them from the assignments as long-term capital gains. So these are pretty aggressive taxpayers, we might say, right, guys? And the question is spelled out on page 597, right, Vikram, where it says at the end of the paragraph that is continuing it from 596. Says such computation fixed the 1951 equivalent of cash value at $487,647.46 for the bonus payments paid in 1951 and agreed to be paid thereafter, aggregating $511,000. The Commission determined the taxpayer should be taxed in 1951, and the tax court held in favor and said it was taxable in 1951. What was the taxpayer's argument on why it should not be taxed, Vikram, in 1951? What was the, I'll say, sine qua non that the taxpayer said was absent that made this promissory note not taxable? What was the crux of the taxpayer's argument? Do you recall? Joe, do you recall?
So what kind of said, so I have that he said that the contract was a capital asset, so we had capital gain. Is that his argument, or?
No, but why did he, I mean, now we're getting into a timing issue. Why did the taxpayer say, not taxable this year? What did they say was central that was missing? because remember, it's cash equivalent, you're not receiving the funds, but it's still taxable, right? So you can't just limit your analysis to receipt of the funds. Taxpayer, on page 599, I have outlined in red. In the first full paragraph, 6 or 7 lines down, on page 599, it says, the taxpayers urge that there can be no quote-unquote equivalent of cash obligation unless it's a negotiable instrument. Everyone see that? It must be a negotiable instrument. Does the court subscribe to that? And it must be a negotiable instrument? So if you read the following paragraph, it says, well, sometimes a promissory note, which is negotiable, is not a cash equivalent. And they say, we think the converse of this principle ought to be applicable. We're convinced that a promise to pay by a solvent obligor is unconditional and assignable, not subject to set-offs, and is the kind frequently transferred to letters, so and so and so and so, that it is taxable. So the court does not buy in to the taxpayer's logic, does not say it must be, categorically must be, negotiable. Right? So taxpayers lose. And this makes sense. Why? Because when they received the notes, they were able to quickly transfer it and receive cash. So even though they were negotiable, they were assignable. And to me, they certainly reeked of being a cash equivalent. So I'm not entirely surprised, nor should you be, at the outcome in this case. Now the Horning decision. Any football fans out there? And I know there are a few, but it'd be dangerous if you raise your hand and say you are. And if you, hopefully you've read the case. Vikram has. I don't know. Yeah, did you get a chance to read it?
Yeah.
All right, and by the way, if you read this case, hopefully you have, about 2 weeks ago, I sent you an email address because about 6 months ago, I was reading the newspaper, and I'm not a big sports fan kind of guy, so I'm not quite sure why I was reading the sports section, but maybe there's some greater power out there that said, read the sports section. So as I'm reading it, I'm reading about Paul Horning. And you guys saw the case? Did you guys remember what is Paul up to in the year 2018? Anyone read my spam? DK, do you have a chance to read that? Do you remember what that was about?
Yeah. Helmet issue.
Helmet issue. Paul is not a happy camper. He claims that, like many football players, that he suffered during the repercussions of being hit hard, right? And many football players are bringing lawsuits, right, for onset of early dementia. So Paul's still in the news, guys. All right? So 50 years later. So what happened 50 years ago? Set the scene, Dan.
He was a pro football player, as we spoke about, and he receives a Corvette as an award for receiving MVP honors in the championship game.
So he receives a brand new Corvette. All right, everyone get the visual? Does a great job, and is it the Heisman Trophy?
I think it's just the MVP.
MVP, okay, MVP. He wins the MVP, and he's handed, I think he's given keys to the car, right?
Well, they let him know that
He's at least won the car, right? How does Paul report this?
He reports it as nothing during the year that he received it. I think he received it on the 31st of...
He receives it definitely, he wins it on the 31st.
But I guess it was a Sunday, and the car was somewhere else, and he had no access to receive it that day.
Right, but let's just, how does he report this?
he sells the car, reports it,
Okay. Sells it, reports it,
for no gain or loss.
why?
I guess as a prize or gift, I mean?
Right, if you recall, at least, on the top of page 603, he reports it as a, gift. And for some reason, well, not for some reason, he reports the gain as being none, all right? Everyone see that? So Paul subscribed to the notion that this is 102A. But we know, right, everyone in this class knows, I hope you know, fingers crossed again, this is not a gift, right? This brings us back to our first class. What code section applies? 61, right? Everyone agrees? Code section 61, it's an accretion to wealth. Under Duperstein, for sure, this was not given out of disinterested generosity. He earned the Corvette. And the question is, not a question of is he taxable, which year should he be taxable in, right? Paul would like this car to be taxed in what year?
I'm not sure where. Was it mentioned?
No, what year?
He didn't pick up
He didn't pick it up, but now that he knows he has to, okay, the light bulb's on. What year would Paul like to report this as being income? In the year he won it, or the next year?
I guess the next year, that's fine. I don't know what else he has going on.
All right, so let me just ask, would that be true, Brian? Or Jacqueline?
The next year.
You say he wants to report the next year.
Yeah.
Angie, you agree?
I'm not quite sure, but knowing that they want to defer income.
Generally, taxpayers want to defer, but is that true, Kim, in this case?
Yeah, he wanted to wait till next year. I wasn't paying attention to that, but it was definitely next year.
Definitely, Amanda?
No, it says he argued that he constructively received it in 61.
Why would he want that, Amanda? Did he lose his mind 50 years ago? Forget about the helmet, right? Did he lose it back in whenever? Back in the year this argument was made. What was going on, Ben?
If I were to just take a guess, maybe he's getting some sort of incentive, bonus, earnings recognized in the following year as a result of winning the Super Bowl.
Why might you think he would want to include it in the earlier year? Not because of an incentive or bonus.
Well, he might recognize a higher income later.
What year is this case, what year did he win it?
61.
And what year is this case being argued?
67.
And what year, how many years is the statute of limitations generally, guys? Generally 3 years, except for a substantial understatement, then it's 6 years. But in this case, this is probably a 3-year limitation, code section 6501. So my guess, and I think I'm right, guys, it's not made clear, that he would like it the earlier year, okay, because the statute of limitations is probably run, and the IRS would have no recourse against him. If the IRS is successful in year 2, then they can collect tax. The agency can collect tax. So that's what's probably going on here. It's an unusual case where you have the taxpayer arguing the earlier year, the IRS saying, no, 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 not until year 2. Now, do you think the judge who's sitting on the bench, who's, last I checked, is a human being, who probably gets paid 1/10 of what a professional football player, do you think he or she can have much patience for the football player who reports 0 income on receipt of the Corvette? I'm just, you gotta remember, people are humans, so I'm not being that cynical when I say I'm not so sure how patient the judge is going to be in this case. Putting that issue aside, And now they see the taxpayers the one arguing the earlier year. What does he say? What principle applies here? What does he invoke to say, right? Because he didn't physically receive it. Everyone agree? He didn't physically get the car in his possession. He couldn't physically drive the car away that day. So what does he say he has? Andrew, you have your head up?
I think the doctrine of constructive receipt.
Right. He says, hey, I constructively received it. I didn't physically get it, but I constructively did. Right? This is my car. Right, Andrew? Is that compelling, Andrew, to the court, or did? Is that compelling that the doctrine, and Andrew, you're shaking your head. Why is that?
Well, obviously, the court hoped that because the car dealership was closed on that day, he couldn't actually get the car, so he didn't actually have the means of receiving the car until 1962 in January.
Yeah, I mean, it really wasn't his car that he had in 1961. Constructive receipt means that you can literally get it, and I'm doing this on purpose, but you turn your back to the car. Okay? Everyone get the visual? Watching on tape, get the visual? Literally, you're turning your back to it. Everyone agree? And therefore, there's no constructive receipt. And if that car had burned up that night in a burst of flames, okay? Was that his loss, or would they have made him whole? Whose insurance was covering it? Yeah, I mean, it truly wasn't his car, and like I said, you would suspect the judge here is not going to have the warm cuddlies for our taxpayer here. Andrew.
So is that the main difference between the Kohler case, where he received the check and it's a cash equivalent?
So that's a different principle. That's a cash equivalent. This is constructive receipt. There's no cash. There's no cash equivalent. There's nothing.
Right, but that would be the main difference, I'm assuming.
I mean, it's apples and oranges. I mean, it is a significant difference. And we're going to see in one of the problems will bring this theory alive. All right? So at the end of the year, if I say, Andrew, I'm going to pay you a $500,000 bonus, and say, no, don't pay me this year. Pay me that January 2nd. If I offer to pay the cash and you turn your back, you have income. You constructively receive it. Now, at the beginning of the year, before Andrew renders services, I say if you do a very good job and sales increase by tenfold, Andrew, next year, by January 15th, I'm going to pay you $1 million. That's not constructive receipt because we negotiated before you rendered your services. All right? So I think this case is a nice illustration of the doctrine of constructive receipt. And the regulations, guys, just in case you needed affirmation, the regulations under 451-2, regulation 451-2 spells out constructive receipt. Income, although not actually reduced to taxpayer's possession, is constructively received by him in the tax year during which it is credited to his account, set apart for him, or otherwise made available so that he may draw upon it at any time, or so that he could have drawn upon it during the tax year if notice of intention to withdraw had been given. However, income is not constructively received if the taxpayer's control of its receipt is subject to substantial limitations or restrictions. So certainly that sentence would apply to Paul Honig, right? That his receipt was subject to substantial limitations and restrictions. All right, so everyone's satisfied they can handle the first quadrant, right? Ready to move on to the second quadrant? Disbursements. Now, generally you would think, wouldn't you, that, hey, when you paid for something and it's deductible, whether it be under Code Section 162 or 212, you get a deduction in the year it's paid. But it's pretty primitive. Everyone agree? Cash is pretty primitive in the 21st century. And checks, right, can substitute for cash. And that's true. The IRS says, suppose you write a check to charity. And I'm sure you guys are going to be bombarded with emails from the Red Cross, United Way. Send us a check by, December 31st. And even though you haven't paid the check until the cash doesn't come out of your account, say until January, you have the equivalent of payment, right, with checks, even though you're not physically out the cash. There's a revenue ruling, a short one, 54-465. So, we can just put that a check constitutes payment as long as it's put in the mail. What about credit cards? Last I checked, no pun intended, use of a credit card. Most of us feel, or should feel, when we use a credit card, we have a debt. And that debt constitutes payment, right? Even though, again, we may not, hopefully you guys pay on a timely basis the next month, but maybe you won't pay for, you'll just rack up the interest charges, right? And we have a revenue ruling 7838, right? 7838. A credit cards, use of a credit card constitutes payment.
What is the one above this?
I'm sorry?
What is the one above this?
This is 54-465, and a check constitutes payment. Vanderpool. This case stands for a simple proposition. We just learned, did we not, that there's this concept of constructive receipt, right, in this quadrant. Agreed? We have a revenue ruling directly on point. If you're a cash method taxpayer, can you have a constructive deduction? Can you have a constructive deduction? And the answer is no. Everyone agree? There is no equivalent to a constructive deduction. So Vanderpool, the taxpayer has made some book entries, but book entries don't count. So there is no, I will put this down, no constructive, no CD, constructive deduction. Vanderpool. Everyone understand that concept? No constructive deductions. Boston Market. here. Suppose you prepay your insurance, and just keep the numbers easy here. Suppose you prepay your insurance, and it's $100 a month, or $1,200 a year, and you prepay 3 years of insurance, $3,600, right? $100 a month, everyone can do the math. And you physically make a payment to the insurance company with cash of $3,600, right? So you are out cash of $3,600. If you follow the money trail, theoretically you can say or think to yourself, gee, I should get a deduction for $3,600 because I just made a $3,600 payment. Agreed? What does the Boston market case stand for the proposition? You can't do that. You have to capitalize that expense, right? Because if you prepay for 3 years worth of insurance, you have created an intangible asset. Agreed? That will last 3 years. So accordingly, you can only deduct $1,200 each of those years, even though you prepay it. Otherwise, taxpayers can manipulate their deductions and seek to secure them in whatever year was more beneficial. All right? So taxpayers cannot, emphasis on cannot, prepay their expenses and secure deductions. Now, there used to be a rule when I taught this class, beginning on page 611. I used to refer to it as the Zanovich exception. It's under the note, okay? A rule of convenience. On Saturday begins December 1st, right? Everyone agrees? And suppose you're going to pay your insurance bill, your business, and you pay your insurance renewal comes due December 1st to November 30th of 2019. Everyone have that? In a perfect world, how much should you be able to deduct if you're a calendar year taxpayer in the year 2018? If you make a $1,200 payment. In other words, the insurance is $100 a month. In a perfect world, you would only deduct $100, agreed? And you would deduct the other $1,100 because, hey, during this year, you incurred $100 worth of expenses. But remember, right, guys, we're cash method taxpayers. I say it lovingly, we're not the brightest bulbs around, right? That we're cash method taxpayers because we can't deal with the sophistication of being an accrual method taxpayer. Bearing that in mind, Congress, well, initially the courts first, under the Zanovich case, provided an exception that said, gee, if it's just for one additional calendar year, if you made a $1,200 payment, you can take the full $1,200. But then Congress, okay, just opened up a deduction in the the regulations memorialize this in the form, if you look on page 612, where they contain a 12-month exception. So in this case, in this regulation that the authors cite to, 263A-4F1, okay, this is associated with footnote 6. Everyone see that, page 612? 263A-4F. So now beyond a court case, we have this 12-month safe harbor, okay, that you can take the full deduction. Treasury regulations permit you to do that, and you can read the example that follows it, sort of follows the example I just gave you. All right, so again, Treasury is trying to simplify the existence of cash method taxpayers. Code section 461G. You want to just open it up? Code section 461G says that generally interest has to be accrued over the period in which money is being lent, okay? So if you prepay interest, you have to accrue that over the time period you borrow the money. There is an exception under 461G2. This subsection shall not apply to points paid in respect of any indebtedness incurred in connection with the purchase or improvement of and secured by the principal residence of the taxpayer, to the extent that under the regulations prescribed by the Secretary, such payment of points is in an established business practice in the area in which such indebtedness is incurred. So in other words, some of you, I would imagine, have bought condominiums or houses and you've paid points. Anyone here, anyone bought a condominium, apartment, or house? Michael?
Yes.
You pay points?
Yes.
Now why did you pay points? Just tell people why people pay points like yourself.
It reduces the interest rate you pay going forward.
Alright, so when you pay points, it's an administrative convenience, right? That you're sort of paying a fee, and as a quid pro quo for paying the fee, instead, did you take a 15 or 30-year mortgage?
15.
Okay. So instead of paying what made, just tell people the delta.
I don't remember the delta was. I apologize. I know my current rate is 3.85.
385. So let's just say Michael's paying 385. Had he not paid the points, his rate could have been 4%. Okay? And did you pay 1, 2, or 3 points?
1 point.
1 point, okay? And did you pay it? Now, when you borrowed money from the bank, did you come with a check to pay the points, or?
No, I came with a check to pay the points. I knew the tax bill.
Okay, so if you don't, and then you can answer this case. What happens in this case, Michael? This is the Cathcart.
Yes, in this case, he netted the amount, and because they
just tell people what that means.
Oh, so instead of getting, I'm making up a number, 400,000, he said, look, let's just make it 380.
No, I think he said, let's make it 405.
Let's make it 405. And the way the court saw it was.
Okay, so in other words, the points here, he wanted to borrow 400, and the points here to get the reduced interest rate was $5,000, hypothetically.
Yeah.
So instead of paying the points, he said, oh, I'll just borrow another $5,000 effectively. Okay, everyone got it? So he's not paying the points directly, he's paying it indirectly by borrowing more money. Again, his original loan would have been for $400,000, but he wants to get a reduced interest rate, so he's paying $405, right? So it's an additional $5,000 he's borrowing. He would like to deduct the $5,000. Why? Code section 461G2. And like most taxpayers, you want to deduct, right, whatever you can earlier rather than later. Agreed? The deduction today is worth more than the deduction tomorrow. But truth be told, in this case, with respect to that $5,000 extra, he's going to take 30 years to pay off that $5,000 extra, right? Everyone agree? It's a 30-year mortgage. In contrast, where Mike comes to the table and he's actually physically coming with a check and he's paying the points, Michael's feeling the pain, right, that day. Does the court permit the taxpayer an immediate deduction, Michael, here?
Yes. Oh, in this case, no. For me, yes.
In this? For Michael, yes. For this taxpayer's no, right? Because this taxpayer, the takeaway, guys, for anyone in this room, if and when you buy your first house or second house or apartment or condo, if you're gonna pay points, even if the bank says, and most banks will say, oh, don't worry, we'll just increase the loan amount. No, you bring a check, or you tell your client, bring a check to the table. Everyone agree? Because if you don't, Code Section 461G2 does not apply. And you will have one unhappy, you yourself will be unhappy, or your client will be unhappy. One or the other is not going to be good for anyone. Now, not to scare anyone on a Monday, rainy Monday night, but if you look at revenue rolling 87-22, just to show you what the world could be at some point, outstanding, and Michael secured an interest rate of 3.85%. In yesteryear, certainly, and this is not, how do we say, Treasury is not going nuts when they put together this revenue rolling. Interest rates hovered in the 16-17% range. There's some really high inflation. And here we have a taxpayer refinancing an old loan and also borrowing money for improvements. Okay, so they're going to refinance and borrow money, and they're going to borrow a total of $100,000, $80,000 dedicated to refinancing, $20,000 to an improvement, and they're paying points, right? And the question is, what's immediately deductible? What has to be amortized over the term of the loan? And if you look on page 617, you can see the court bifurcates this and says that the portion relating to refinancing has to be amortized over the term of the loan. Conversely, that portion which relates to an improvement can be deducted immediately, which makes sense, right? Because the statutory language says you get an immediate deduction if it's a new purchase or for improvements. Right? So here we have some things to think about in the next quadrant about what's deductible and when it's deductible. Let's see if you guys are really up to speed here. On page 617, there's two problems on page 617, 618. You have a lender lends out money at a legal rate of interest to debtor. Debtor is required to pay $5,000 interest each year on the loan, which extends over a 5-year period. Interest is deductible under 163. The agreement calls for payments of each year's interest on December 31st of the year. Both parties are calendar year cash method taxpayers. Disclose the tax consequences to both parties under the following alternatives. Okay? So we have lender, we have debtor. Now, labels are going to be important here. This deals with an inclusion issue, this deals with a deduction issue, and if you don't mind me saying, you may want yet another color to point out they're both cash method, because that's going to help you. The more anchors you can put, the easier it is, right? So we're dealing with an inclusion issue, cash method, deduction issue, cash method. Things will get complicated because sometimes you have a cash method on one side and an accrual method on the other. You got to be careful about that. Debtor mails a check for $5,000 interest to lender on December 31st of year 1. It is delivered to lender on January 2nd of year two. Okay? So, when does debtor get deduction, and when does lender have to include it? Jacqueline, Angie, when do you get a deduction? And Kim and Brian, when do you have to include it? Just say it loudly. Jacqueline, what year? Year one or year two? It's binary.
Year one for the deduction.
Year one? Do you agree or disagree?
I agree.
Year one, right? It's check 54,465. Year one. Kim, Brian, when do you have inclusion? Year one or two? Year two, Brian?
Year two.
Year two, when you receive it, right? By the way, again, guys, something I mentioned in the first class. Do not look for symmetry, right? Do not look for necessarily for the answers to be symmetrical, where if one deducts it in 1 year, the other one has to include it, or vice versa. Recipe for disaster. Debtor mails the check in A above on December 30th of year one, but is delivered to lender on December 31st of year one, but after all, the banks are closed. So in this case, when do you get a deduction? In this case, Diane and Jonah, when do you get a deduction?
Year of one.
Year one, Ben, agree or disagree?
Agree.
Agree. David, so Bob, when do you have to include it?
Year one. Year one.
Why?
Cash equivalent.
Yeah. And we have a case, collar case, for that exact proposition, right? Special C. Debtor gives lender a promissory note on December 31st of year one, agreeing to pay years one interest plus $50 on January 30th of year two. Debtor pays off the note on January 30th of year two. So, Ann, Kathy, when do you get a deduction? And then Sarah and Jason, Sarah, Jason, when do you have to include it? So when do you guys get a deduction?
Year one.
What do you say year one? And Tan, do you agree?
I'll say year two.
Okay, and Matt behind you, who's right and why?
I'm gonna say year two because that's when we're actually receiving the,
You're talking about the deduction, not the inclusion. Year two or year one?
I'm not sure. I would say year two.
Just
Yeah,
why?
I think.
Why?
Because it's a, you're only giving a promissory note year one. You're actually.
Oh, just be careful. I'm using your exact verbiage. You're only getting. Remember, Matt, just be very careful. You're giving, you're not getting. Right, Matt? So I come back and say, when do you get a deduction, right? Have it?
I think year one.
What do you say, year one?
Dated.
Say again?
It was easier than those in year one.
Corey, agree, disagree? Do you want to agree with him or you do agree with him?
I agree with him.
Let me just ask you, if the person is out is he out the cash? So are there any exceptions here that would apply? He's essentially just saying, I'll pay you later. generally you can't, as a cash method taxpayer, get a deduction, right? There's no constructive deduction, right? Everyone agree there's no equivalent like constructive receipt. So here, it's gotta be year 2, guys. Unless you can think of a good reason, if you're not out the cash, you're not getting a deduction in year 1. Tara, Jason, when do you have to include it? Jason, agree or disagree? Why?
Promissory note is,
Patrick, agree or disagree?
I wanna say year 1.
Why?
Cause I wanna, I don't know, just got a good feeling.
Well, and Dave, would you agree?
I think it's year 2.
Why?
Isn't a promissory note not a cash equivalent, it's just evidence of indebtedness?
It depends, right? Didn't Cowden say, depending if it's negotiable, if it's made by a sovereign payor, all those intentions, or is it a mere evidence of indebtedness, right? Right? Because we're talking about inclusion issues. Is this meant to be a cash equivalent? Or is this merely saying, hey, I owe you the money, I just can't pay you this year? What does it more closely resemble, guys? If I give you this note, I really didn't mean to pay you, right, guys? It's not like I gave you a check, so chances are, in terms of inclusion, you would probably not have to include it until year 2. Doesn't have that same feel, right, as a cash equivalent. Question D. Debtor offers to pay off lender the $5,000 interest due on December 31st of year 1. Lender suggests the debtor pay it on January 2nd of year 2, which debtor does. So when does the debtor get the deduction? Elizabeth, Ning, when do you get the deduction? And then Angel, Matt, you tell us when you have to include it. So Elizabeth, Ning?
Year 1.
Ning, agree or disagree? I'm sorry? Think year 2, okay. And Ron, who's right or who's wrong?
I say year 1.
Why?
This seems to me like a constructive receipt.
But hold on, you're doing a good mistake today, okay? Good mistake today, Ron, not a good mistake next week. Because we're asking about a deduction issue, right? There's no such thing as constructive receipt when it comes to deduction, right? I'm asking when the debtor gets to deduct it. Leo?
I would say it's gonna be in year 2, because he actually pays it in January.
Yeah, it's when he pays it, right? Now, Angel, Matt, when do you have to include it?
You would include it in year 1.
Why?
Because that is constructive receipt. He said, no thanks, I'll take it later. But he could
Angel,
have
agree,
received it in year
disagree?
1. I don't think he said.
Oh, I'm doing, I'll admit I'm doing that. I'm getting fooled by.
I'll agree.
So you're gonna agree. What concept, Alvin? I mean, this is quintessential constructive receipt, right, Alvin?
Yes.
Regulation 451-2. Someone throws money in your direction, right? Someone throws money in your direction. Can you simply say, you can say, I don't want it, pay me next year, but under the regulations, you're still taxable in the year it's constructively received. Right? All right, so this is a good illustration of constructive receipt, guys. Everyone agree? Everyone sees that? Question E. Debtor pays all 5 years worth of interest, $25,000, he's out $25,000. The lender in cash on December 31st of year 1. Okay. What year does debtor get the deduction? In this case, let me just ask Andrew, Nick, Joe, Vikram, what year do you get deduction? Andrew, Nick, Joe, Vikram, when do you have to include it?
You can only include the first year's worth of interest.
Nick, what do you say?
I agree.
What's your authority? Say again, Nick?
461G.
Yeah, 461G. So, year 1, $5,000. And Joe, Vikram, what do you have to include? Joe, Vikram, and Mike, if you want to chime in.
I think you can include all of it.
Vikram, Joe, agree, disagree?
I agree.
Why? What's our theory?
461G.
So that's for deductions. We're talking about inclusion. Right, so do not use code section 461 in this context. Wrong code section. Michael, why?
I don't know what the code section is, but, I think because he has all the cash paid to him, doesn't have to pay tax.
Alright. So, year 1, and again guys, don't look for symmetry. Why 25,000 in year 1? It's cash method taxpayer, he gets all 25,000. Is there any restrictions on how he uses this? Elizabeth?
Wouldn't that become deferred income? Doesn't that qualify for deferred income?
From what code section? Where you won't find it. Because let's face it, if you're Congress, when's the best time to tax this money?
When you get
Physically has the liquidity. Because tomorrow, could be going to Atlantic City, right guys? Red or black? So good time if I'm Congress. Good time to tax is now. You want authority? We're about to look at it. There's a case called North American Oil. And North American Oil essentially says that if you have unbridled use to property, unbridled access to income, it's immediately subject to tax, which makes sense, right guys? Because, you know, all kidding aside, they could use the recipient here all 25,000, however he, she, or it pleases, right? There's no limitation. So we can't feel badly about taxing this taxpayer immediately. You have unrestricted use to the money. Question F. Question E and F, I'm not quite sure what the author's point is. It seems, question F says, same as E, except debtor does so because the lender makes it a condition of extending debtor another loan. And just so you know, I don't think that has any bearing here. The outcome would be identical, even if there's a condition. Hey, pay me all up front, or else I'm not gonna give you a loan. The outcome's the same. Not gonna change the outcome.
Question.
Yes.
What if the lender, refuses to accept that, he just wants it 5,000 every year and refuses to take the 25 up front?
Well, it depends. If the contract said, hey, pay me five.
I'm not talking about F, I'm talking about E.
No, in E,
Okay.
I'm lending you money, okay? And I say, pay me 5,000 each year, you wanna prepay me? But the contract says, pay me 5,000. If I don't get the 25,000, even if you give it to me, then I'm taxed. But even if you offer it to me, there's no constructive receipt because we negotiated a different deal. The fact you want something else now is immaterial.
Right, so then the lender,
There's no constructive receipt then,
okay, thank you.
even if you offer it to me. Question G. Debtor pays year one $5,000 of interest in cash on January 2nd of year two, and as agreed, pay year two interest on December 31st of year two. So when do you get, in this case, BK and Nick, when do you get a deduction?
Year 2.
Year two? Nick? Why?
That's when it's paid.
Year two, right? That's when it's paid. There's no constructive deduction. Jacqueline, Angie, when do you get to include it? Year two, right? When it's received, right? Question 2. Lawyer renders services to client which are deductible to client under 162. Lawyers held to both lawyer and client if both are cash method county or taxpayers in each of the following circumstances. So once again, we have a lawyer and client. And we're dealing with income and deduction issues. Both lawyer and client are cash method county or taxpayers in each of the following circumstances. Lawyer sends out a bill for $5,000 on December 24th of year one. Client pays the bill on January 5th of year two. Okay? So when does client get a deduction in this case? When does client, David and Dan, when does client get the deduction? Lost, Dan?
Year two,
Why?
cause that's when it's paid.
Yeah, right, David? He's making payment. Your cash method, you pay it, that's the year you get a deduction. Everyone agree? Kathy and Tan, when do you have to include it? By year two, or Kathy, you agree?
Yeah.
Say it loudly.
Yes, I have.
Why?
This,
Because the lawyer didn't receive the bill until the case.
I mean, physically he gets the money in year two, right? Let's not overcomplicate it. sends a bill, $5,000 on November 15th. Client immediately pays the bill using an Amex card. Amex pays the lawyer $5,000 on December 15th. Client pays the American Express $5,000 credit bill on January 15th of year 2. So, Ben and Jonah, when do you get a deduction?
Year 1.
Jonah, agree, disagree?
Yes.
Why? And why?
Is
Did
this,
you-
is under one when,
We're talking about the claim. When do you get a deduction?
year one?
Why?
Because he did pay with his credit card 1 year.
All right,
December.
and we have a rule that if you use the credit card, that's the equivalent of payment, right?
What is that revenue rule? It's
78-38.
That's under 70-30.
Revenue rule. And Annie and Francis, when do you have to include it?
Year one?
And when, Annie, agree?
Year two.
Frank was right?
Year 1.
Why?
So, it's paid right away, cash.
Right, gets the payment in year 1, right? Right, Andy? He's got the physical cash.
Is that because the payment was received in year 1, or because the bill was sent out in year 1?
Because he received the cash, not because of the bill. He's not an accrual method taxpayer. Right? Don't get confused.
So it's when the credit card pays.
I'm sorry?
It's in the year that the credit card pays.
Yeah. Andrew?
So I just wanna clear this up for myself. You mentioned that he's not an accrued method accrued method payer. So it's saying in terms of large corporations where they have accounts payable and accounts receivable, that's a different story, I'm assuming.
Yeah,
Yeah.
we're gonna go through that.
Okay.
Hold that question. We're almost there, almost there. Question C. Prior to rendering services, lawyer and client agree that lawyer will be paid $2,500 in year 1 and $2,500 in year 2. Client pays lawyer $2,500 December 24th of year 1, $2,500 in year 2. So, now Angel, you're back. Angel and Alvin will ask you when you get a deduction, and Matt and Frank when you have inclusion. So, Alvin, when do you get a deduction? Angel, see if you agree.
Say year what?
Hey, Angel, agree or disagree?
I said 2,500, year 1, 2,500.
Is that what you meant to say, Alvin?
Yeah, that's what I meant.
Alright, that'd be right. You get to deduct what you pay, right? So it'd be $2,500 in year 1, $2,500 in year 2. And Matt, Frank, when do you have to include this?
Same thing.
Same thing,
2.5 in year
right?
1, 2.5 in year 2.
Yeah. That's when you see the cold cash. All right. Question D. Client calls lawyer at 4 p.m. on December 31st of year 1, saying she has lawyer's fee statement, has made a check in full payment, and she's about to leave for Europe. We'll leave the check with the desk clerk at client's apartment. Lawyer is ill, has no one to pick up the check, and finally picks it up on January 2nd of year 2. Okay? So everyone got that? She's got the bill, she made the check in full, about to leave for Europe. She's gonna leave the check with the desk clerk at client's apartment. Okay. Anyone have a gut on when the client can deduct this? Now, if you look at the authors cite us to a case, okay? Truth be told, you guys can read the case for yourself. It really doesn't mirror this fact pattern, so it's a little bit of a reach. I don't know if any of you have really looked at this case. It doesn't really mirror the fact pattern. So, having said that, obviously the lawyers are bringing us back to the first case, right, in this chapter, the Collar case. And that deals with an inclusion issue, right? That case is, I'll say, more compelling. In that case, right, it was year 1, not year 2, because the person got physical possession. Everyone agree? And in this case, is the lawyer getting physical possession? Go ahead, Andrew.
No, I mean, she's not getting physical possession. She's being told that it will be left with so-and-so, the client's clerk.
Right, and is that an agent of the lawyer?
No.
No, it's not like, look, if the client came to the lawyer's, even if the lawyer was sick, and the check was brought to the lawyer's office, and the lawyer didn't have physical, but the lawyer's agent received it, or proxy received it, we would all agree that's pretty damn close to the Collar case, year 1. This case, it's not as compelling. So I would argue, talking about the inclusion issue, probably year 2. Now, also, if the client had mailed the check, usually mailing constitutes timely payment. In other words, the date you mail for IRS purposes is the date considered submitted. Just like a check that you make payable to the Red Cross, even if it's December 31st, and you mail it, okay, and the Red Cross doesn't receive it until next year, you can still take a deduction this year. So, go ahead, Andrew.
That's not what she did.
Right.
So it's only deductible in year 2 because that's when the payment was actually.
Look, we're not gonna, and I apologize on a rainy Monday, we're not gonna get the crisp answer for your notes that we're looking for, that you're looking for, that I'd like to deliver, because crispness here isn't, there's no crisp answer to this, okay? So I think the better answer personally here, the IRS should not complain if it's year 2 in year 2, is my opinion. But don't, I'm saying this with a question mark, okay? This is not, I think the other ones, we can all feel comfortable, very comfortable with the outcome. This, not so much. We're all good? You guys are ready to talk about the accrual method? Frank's giving me the thumbs up. All right, everyone, 2 thumbs up, even better. All right, you guys ready? Accrual method. Fill in some of these more quadrants. So we have a Supreme Court decision to greet us, Spring City. And the question is, suppose we earn money in year 1. It's not entirely clear that whoever owes us money, even if we earned it, is going to be able to ultimately pay us, right? I would agree that sometimes we work and we're accrual method taxpayers. It's unclear whether or not we're going to actually get paid, right? So, in that kind of circumstance where we don't know we're going to get paid, do we still have to accrue it, even if the solvency of the payor is somewhat suspect? And Spring City stands for a simple proposition. The answer is yes. that we can, meaning the person rendering the services or supplying the goods, we don't want to let taxpayers make that judgment, because taxpayers can just game the system, right? They can say, gee, I don't know if I'm going to get paid and not accrued into income. And we can't let the system falls apart if we allow each taxpayer that judgment. So unless you're going to write something off as being unpayable, because the payor is totally insolvent and it is declared bankruptcy, you got to accrue it in income. If subsequently, when the money comes due, the payer can't pay, you can take a business loss, right? You can take a bad debt loss, okay? So the point is, when you earn it, through accrual method, you got to take it into income. It subsequently comes to light that you're not going to be able to get paid, so be it, you'll write it off, all right? Simple proposition. There's a revenue ruling that follows. 2003-10, this is on page 620. It describes three circumstances, not hard to follow circumstances, where maybe a strict reading of the code and regulations would require accrual, but when you scratch your chin, it doesn't make sense to accrue it. So let's take a look at page 620 at the three issues. Under the all events test of 451, when does a taxpayer using the accrual method accrue gross income if the taxpayer ships goods and the customer disputes the liability of the taxpayer because of a clerical mistake in the sales invoice discovered in the next taxable year? So I ship goods to Patrick, okay? Picture if you will. I ship goods to Patrick, in which I'm going to make a profit, say, of $100,000 in year 2018, okay? But January 2nd, Patrick calls me up and says, Solid, you blew this. This is not what I ordered. There's some big mistake here, and I really don't owe you this money, all right? So before, now in theory, each year you're supposed to look at it independently. So in theory, under the strict accrual method, I should accrue it into income in 2018. And notwithstanding Patrick's telephone call to me that there's this major clerical error, I'll deal with it next year. Well, just to be reasonable, and the fact is, I know and you know, Patrick is not going to send me money, and it's really going to be problematic, maybe from a liquidity standpoint, because this deal is not what was anticipated. This revenue ruling gives taxpayers a break and says, you know what, Solid doesn't have to accrue it in income. There's been a real clerical error, okay? Similarly, issue 2. Under the all events test, when does the taxpayer using the accrual method of accounting accrue gross income if the taxpayer ships the wrong goods? Okay, there goes Solid again. I'm shipping him widgets instead of wadgets, or whatever you want to say. You know, I ship him totally the wrong goods. Patrick calls me up again January 2nd. It's been a long New Year's, because now Patrick says, you blew it again, I'm not paying you a dime because you shipped me the wrong goods. Do I have to accrue it in income? And the answer is no, okay? I do not. Even though, again, theoretically, I earned the money in 2018, and it only came to my attention in 2019 that there had been a mistake. Issue number 3, not as pleasant. Well, it's not as bad, because the first two, me being the vendor, I'm not a happy camper. Situation 3, when does a taxpayer, meaning Solid, using the accrual method of accounting, if I ship goods, more items than the customer ordered, so instead of shipping Patrick 100 widgets, I ship him 150, right? The excess quantity is discovered by Patrick in the next year, 2019, and on January 2nd, in accordance with the agreement, I would have shipped him another 100 widgets, but since he already has 150, I just shipped him another 50, right, for 2019, because he just wants 100 widgets each year, right? Everyone agree? So he's gonna accept the 150 that I shipped him in December. Do I have to accrue that in income, even though, truth be told, it really should have been 100 this year and 100 next year? Well, he's tacitly accepted the fact that he's willing to pay me for the 150. So the answer is yes. I have to accrue the whatever income I would have earned on the entire quantity, not just what Patrick had anticipated. All right? So this revenue ruling looks at 3 distinct fact patterns, not hard ones to follow, and then it comes to a sensible outcome, or sensible outcomes plural. I just called your attention the accrual method, because we're used to the cash method. Under the cash method, it's physically when do you receive the cash equivalent or constructed receipt. But the accrual method, spelled out on page 621 in the third full paragraph. So it starts section 451, okay, and it talks about the regulation. If it goes 5 or 6 lines down in that third full paragraph, it says, all the events that fix the right to receive income occur when the required performance takes place, the payment is due, or the payment is made, whatever happens first. So you have to meet a very, very superficial test to accrue money into income when the earliest of these 3 items occur. When the performance takes place, payment is due, the payment is made. I just called your attention. Code section 451B is new. If you want to just take a look, open up brand new to your code. And on page 623, it's spelled out, page 623. (451B). We now have a 4th event, which may accelerate the accrual of income. Under 451B, the all events test is treated as met when an item of gross income or portion thereof is taken into account by an accrual method taxpayer in an applicable financial statement. Thus, an accrual method taxpayer generally may not report an item in a financial statement and defer inclusion of the item for tax purposes. So in other words, for the first time, under the Internal Revenue Code, under the all events test, if you accrue it in income for financial accounting purposes, you must accrue it for tax purposes. So you can't report mega earnings on your financial statements and say, well, for tax purposes, we didn't have to accrue it. Not going to happen anymore. Then we have, on page 623, this 1932 Supreme Court decision, which I alluded to earlier. And if you recall, this case essentially stands for a simple proposition, that if you have unrestricted use of funds, even if you technically haven't earned it, you're an accrual method taxpayer, but you are given unrestricted use of funds, right? We know under Code Section 61, right? Accretions to wealth, absent an applicable exception, right? Accretions to wealth generally constitute income. Agree? And this is just an extension of this. So if you look at page 625, the last paragraph, it's actually the penultimate paragraph that begins 3rd. The net profits are earned by the taxpayer. look at that paragraph, second sentence. They became income of the company in 1917 when it first became entitled to them and when it was actually received them. If a taxpayer receives earnings under the claim of right and without restriction as to its disposition, he has received income which he is required to return. To return should really say to report, even though it may still be claimed that he is not entitled to retain the money, and even though he may still be a judge liable to restore its equivalent. So if you get money, and you have unrestricted use to it, but someone may sue you to get it back, okay? I give it to Dane, I give him, or Abbott, or pick whomever I give it to in this room. And at some point, I come to my senses and I may sue to recover it back from you. Doesn't matter. We'll cross that bridge when we get there. You may be entitled to deduction if you have to repay me. But in the meantime, if you get money, if you're an accrual method taxpayer, even if you haven't earned it, it's subject to tax. What's my authority? Code Section 61, Code Section 451, North American Oil. Several bits and pieces, but it creates this web of authority. New Capital Hotel. This is an easy case to follow. Easy case to follow. What does this case stand for? What proposition? What did the taxpayer do? Mike, what did it do?
So what happened here was they structured a deal where they made a 10-year lease, and then they said, what we're gonna do is I'm gonna pay you the last year up front.
And so everyone get the visual. Taxpayer here receives the rent of year 10. So picture, if you will, you rent the buildings to someone, and someone says, you know what, well, I'll pay you monthly, but I'm going to pay you year 2028. I'm going to pay you this year, okay? I'm going to pay you years 10 up front, okay? I'm going to pay you $30,000. And we know for financial accounting purposes, when would you accrue that in income for financial accounting, for GAAP purposes, guys? When would you accrue it? Year 10 when it's earned, right? Because that's going to be a much clearer reflection of income, right? What does this case say, Michael? When do you have to take it into income?
The case said you could not if you try to get the deduction early, they said no because you have to.
We're not talking about deduction, we're talking about inclusion. So don't steer your conversation away about deduction. This is an inclusion issue, right? Talking about inclusion.
Yeah, I think at the end of the day they said it should be included.
You have to include it immediately, right? Because you had unfettered use to it. Right? So this is going to be another exception. Right? North American Oil. Right? Even though technically you haven't earned it, if you have unfettered use of it, you got to accrue it, you have to take it into income. Does that make sense from a tax policy perspective? Sure. Once again, if I'm Congress, I want taxpayers to accrue it sooner rather than later, particularly when they have access to the funds. Alright? So new capital is very similar to North American Oil. Stick with me for a few more minutes and then we'll take a break. I just want to get done with this slide. So, I will share with you that taxpayers who got prepaid, suppose, and there's actual cases on this, you'll see on page 629, there's actually two different cases. Hartnell and Tampa Bay Devil Rays. a fiscal year, and your fiscal year is such, you play baseball in April, May, June, July, August, September, October, 7 months, right? April, May, okay? And you get paid $7 million up front for preseason tickets. Everyone have the visual? And your year begins, your fiscal year, May 1st. Let me do this. June 1st, where April. So you want to take that $7 million and say, look, I know I got $7 million, and I know under North American Oil, I should be paying tax on all $7 million, right? Because people prepay their tickets. Everyone got the visual? But the taxpayer says, gee, it's not like we got like in New Capital, they got year 10 payment. We're just talking about a little deferral here because we should only have to take the first 2 months or $2 million into income. The other $5 million is part of our year 2 fiscal year. $2 million year 1, $5 million year 2. That's what the taxpayer argues in the RFL case and pretty much in the Tampa double raise case, okay? Tampa Bay double raise case, is that the taxpayer knows with certainty when they're earning the $2 million, when they're earning the $5 million. And guess what? Even though there's this Supreme Court case, North American Oil, the courts have said, you know, that makes sense. The taxpayer really shouldn't have to. In North American Oil, they just got this lump sum. As opposed to in these 2 baseball cases, you really knew when the taxpayer was going to earn the $2 million and the $5 million, okay? And the taxpayer prevailed, and the IRS subsequently, if you read this, issued a revenue procedure, 2004-34, which essentially said, that's okay. And for the first time, new in your new edition of this book, page 630, there's a new code section, 451C. Code section 451C. What does code section 451C say? Treatment of advance payments. Generally under 451C, this is the first full paragraph on page 630. You have to accrue it all in the year of receipt, or you can make an election to defer the advance payment. You can make an election to defer the advance payment up to 1 year. Yes.
On a financial statement point of view, wouldn't that be unearned revenue?
How much?
For ticket sales, say?
So I'm not sure, just express your point one more time.
So, I mean, I'm thinking of it also like in terms of like a magazine, you have,
Prepaid prescription.
right, so it's, unearned revenue.
Right?
Is that sort of the same thing?
Yeah, I mean, this allows you to accrue it over up to 2 years, up to the following year.
Okay.
All right, so we're going to see an example of this, but just letting you know that Congress has decided, beyond just relying on case law, okay, these 2 cases in this revenue procedure, Congress in the last year, 2017, memorialized this, codified it in the form of Code Section 451C, where now you can rely on statutory authority to defer prepaid income up to 1 year. Now, we're inventories, guys. If you have inventories, ever since I taught this course, you had to use the accrual method. You have inventories, you have to use the accrual method. However, on page 633, there's code section 471C, which is brand new. It says for certain small businesses, okay, for certain small businesses, you do not have to use the accrual method. And it's spelled out on page 633, 634, that you can rely on the cash method for the first time. Right? So that's new for us. So we have 451C. Okay, 451C dealing with this 1 year deferral. And then also with respect to inventories, we have this 471C. Where for the first time, even though you're using inventories, you may, if you meet these qualifications, you may use the cash method. Okay? And you guys can read for yourself pages 633, 634. The authors do a fine job of spelling this out. Let's do this. Let's take our 7 or 8 minute break, and if you can, come back in a timely fashion, and then we have to finish this. So let's keep trucking. So, in terms of deductions, we have cash method inclusion, cash method deductions. Accrual method is the old man's test. And again, it's been augmented most recently by adding financial statements and also permitting an exception to the accrual method where you can use for certain small businesses with respect to inventories the cash method. Let's talk about deductions, okay? Now, deductions. When does the taxpayer using this is revenue ruling 2007-3. When does the cash method when does a taxpayer using the accrual method incur liability for services? And it describes two situations, and it looks at the regulations. This is on page 635. There's a regulation there. And it has 3 tests that have to be met. Now they're conjunctive. All 3 tests must be met for taxpayer to secure a deduction. All events have occurred that establish the fact of liability. The amount of liability can be determined with reasonable accuracy. And this is the hardest part to meet, economic performance has occurred. Okay? Economic performance has occurred. And that's the hardest of these events. Okay? Now, economic performance, just to call to your attention. Now we're moving, just keep in mind, this is Code Section 451, this is Code Section 461, right? Code Section 461. And here, okay, Code Section 461H delineates, Code Section 461H delineates economic performance. And it spells out when economic performance is met. Again, you cannot, as an accrual method taxpayer, secure a deduction until economic performance has been rendered. And this revenue ruling describes that merely executing a contract, when you execute a contract, you may be liable to make a payment, right? You execute a contract that you owe, make up a number, $100,000. Can you accrue that $100,000? And the answer is absolutely categorically no, unless the economic performance has been rendered. The fact that you are liable does not render the fact that you get a deduction. I will repeat. The fact that you are liable for something does not mean deduction. Okay? And that's spelled out at the very end of this revenue rule. The mere execution of a contract without more does not establish the fact of a taxpayer's liability for services.
You said the fact that you're liable is not.
The fact that you sign your name to a contract and say, you know, I'm gonna pay you, Vikram, $100,000, doesn't mean I can accrue that as a deduction until you render your services. All right? So until economic performance is had, I cannot accrue that liability. We had the Sushler decision. If I could pronounce it, that would be half the battle. Page 637. Frank, you remember what happens here? Right there, Dane? Dane, you have a chance to read it? Dane, was that yes or no? Patrick?
Yeah, I briefly looked it over. So it's the taxpayer was installed furnaces,
Absolutely.
and then he charged like a $2 per call to turn it on and off every year.
Well, they charged a premium, an upfront premium. And like a 5-year service contract, he said, look, every year I'm going to turn it on and off this furnace for you. And I'm going to charge you more for the furnace because I'm going to offer, entangled in this sale, is this obligation on my part to perform these services, right? And he knew each year with some approximation how much it would cost him to render this service. So he said, look, when I sold this, each furnace, I charged more, but simultaneously, I should be able to accrue a corresponding liability because I'm obligated to perform services for the next 5 years. And with approximation, I know, pretty much to the dollar how much each year it's going to cost to fulfill my obligation. Does the court permit this, Patrick?
The lower court did, but I'm pretty sure it wasn't reversed in favor of the taxpayer.
And Mike, you agree, right? Yeah, the taxpayer does prevail. Now, Patrick, given what I've just been harping on, Section 461H and economic performance, excuse my language, but why the hell should the taxpayer prevail here?
He proved his intention that he was going to perform the service.
Yeah, but that doesn't cut it under the economic performance test, right? Falls well short of the mark because there's no economic performance here. Mike, why?
Because I think the way it looked at it is it just kind of made common sense because he hadn't actually earned.
Let me stop you because you're putting your foot in your mouth. You don't mean to, but the reality is, and this is key here, there is no Code Section 461H. All right? So this case predates, right, the economic performance test. In this case, is a reflection of the fact that taxpayers in yesteryear could say, gee, I sort of know what it's going to take to fulfill this liability, and I'll deduct it. It's a good, solid estimate. But you know and I know when it comes to estimations, whose favor do taxpayers generally estimate it? Their own. So Congress, by instituting Code Section 461H, trumps this decision is no longer good. The authors of our case book, which I can't fault them, are just trying to give us a glimpse of what the law was yesteryear, but I can assure you that our taxpayer in the year 2018 would not prevail. So what the authors describe in the note that follows this case is that Congress was concerned that this gave too much wiggle room. It describes the history of back and forth. The beginning of discussion on page 462 describes that Code Section 461H is designed to put all of this to bed. Okay, so it concludes on page 643. The last full paragraph, the enactment of 461H not only resolves the general controversy involving premature accruals, but it also resolves the uncertainty surrounding the use of estimated liabilities or reserve accounts, such as reserve and the social account. So this no longer cuts it. The only time you don't need economic performance, because you guys know by this stage of your career, in your tax career, you have a general rule, and of course, and this is no exception, we have certain so-called non-material reoccurring items. That if there is certain non-material reoccurring items, even if there hasn't been economic performance, we can still take the deduction. Okay? So with respect to certain non-reoccurring, with respect to reoccurring items that are not truly material in nature, we can take a deduction. And we're going to see an example of this shortly. This is spelled out, though, if you want to get a glimpse of this statutorily under Code Section 461H3, exception for certain reoccurring items. All right. Any questions before we look at the problems on page 645? Everyone ready to handle the accrual method? Problem 1. Lawyer renders services to client, which is deductible to client under 162. Lawyer sends client a bill for $1,000 on December 24th of year 1, and client pays the bill on January 5th of year 2. Discuss the tax consequences for lawyer and client, assuming, even if unlikely, they are both calendar year accrual method taxpayers. Okay? So we're talking about deduction issues, talking about inclusion issues, and they're both accrual method. So, PK and Nick, when do you get to deduct? And Leo, Mike, when do you include?
Year 1?
Year 1. Nick, agree?
Agreed.
Get deduction in year 1. Why is that?
Is the reclassification from that?
What's the most important one?
Economic performance occurred?
Right, everyone agree? Economic performance has occurred. Get deduction in year 1. Leo, Mike, when do you have to include it?
I would say year 1 because you're earning it in year 1.
Mike?
Agreed.
Year 1, everyone agree? All right, we're good? Question 2. Lender lends out money at a legal rate to debtor. Debtor is required to pay $5,000 interest each year on the loan, which extends over a 5-year period. The interest is deductible by debtor under 163. The agreement calls for payment of each year's interest on December 31st of the year. The loan is made on January 1st of year one. Both parties are calendar year accrual by the taxpayers. Discuss the tax consequences to both parties under the following alternatives. This is one. And this is lawyer or lender, excuse me, lender and debtor, just to make my point clear. These are both accrual method taxpayers, and again, for exam purposes or for clients, just make sure you label, highlight something during the exam that delineates, hey, what kind of taxpayer is this? On December 31st of year one, debtors having quote-unquote serious financial problems fails to pay lender. Okay? When does debtor get a deduction? When does lender have income? In this case, Brian and Dan, when do you get a deduction? And David and Kim, when do you have to include it?
I think I'm doing deducted.
When do you get deducted?
I think year one.
Dan, agree or disagree?
I agree.
Year one, right? Economic performance, you've had use of the money for the whole year. You're liable, right? You get deducted in year one. David, Kim, when do you have to include it?
Year one.
David?
Year one.
Why? Even though the debtor may never pay you? Right? The first case we looked at, right? You have to accrue it in Spring City. The case Spring City says you still have to accrue it in income. If they subsequently if they don't pay you, you may be able to get a deduction at that point. But right now you got to include it. How about December 31st of year one, debtor does not pay the interest because of a legitimate dispute over debtor's obligation to pay. So, in this case, Jacqueline and Angie, when do you get a deduction? And then Andrew and Nick, when do you have to include it? Any deduction?
Year two.
You get a deduction in year one? Jacqueline, yes or no? Well, let's not even go to year two. We're not even sure if it's year any, right?
Yeah.
Because if you dispute that you don't owe the money, right?
Yes.
You can't, under 461, the all events test, you're saying, I don't owe you a debt, right? So, in that case, you can't accrue a deduction. You have to accrue it in income, Andrew or Nick?
Yes.
Why?
Well, it's a full basis, so you don't, it's almost like you deal with that when it happens.
Well, it's happening.
Okay.
The letter just said, excuse my language, screw off, I'm not paying, I don't owe the money. So, under that case, under the accrual method of accounting, for inclusion purposes, do you have a right to the income? There's a legitimate dispute. The answer is no, right? So if you look at the regulations, under what regulation would I look at? The regulations under what code section, guys? What regulations would I look under, guys? 451, right? I just wanted, I'm testing you. Not 450, not 461, 451. And If you look at 451-1A, general principles, regulation 451-1A, 5 or 6 lines down, under an accrual method of accounting, income is includable in gross income when all the events have occurred which fix the right to receive such income, and the amount thereof can be determined with reasonable accuracy. Well, can that happen here? No.
Says 451
-1A, 451-1A.
That would be the revenue one too, right? To 2003,
That's, what page is that on?
it's on 620.
I just want to get that. I mean, I would.
They were talking about the issues.
Yeah, I think 2003-10 is a little unrelated to this.
Oh,
I mean, the regulations, I think, speak volumes here.
But this is, in this specific example, I mean, they loaned him the money. I would have read this as, they just had a disagreement on whether or not they would pay within the first year, maybe not pay at all.
I mean, it's hard to say dispute the obligations to pay the first year's interest, so what is your point? I don't think they have to include it. I don't think they get a deduction.
Okay.
At least in year 1 until we know more. Question C, what difference in B above if lender includes the December 31st interest in an applicable financial statement for year 1? So the lender is going to include it on the financial statement at least. When do you get a deduction? John Abbott, when do you get a deduction? What do you say, year 1? Well, don't, listen, never, if you don't mind me saying, John, don't ever premise your answer based on what the other party's doing, right? Because that's a recipe for disaster, right, John? The fact someone is doing it in 1 year or year 2 doesn't dictate your outcome. Andrew, what you were gonna say?
Well, I think for C, the client's perspective is the same as in B, because they're disputing it, and they haven't paid it, so they can't.
Yeah, I think, I know that in this case, if you're disputing it, you probably can't get a deduction, right? You say you don't owe the money.
That's a question.
I'm listening,
Even
Ken.
though, 2C would mirror 2B because they, were disputing money, I think.
Yeah.
But I read that applicable financial statement piece.
Well, the financial statement piece, okay, that gets to the issue of inclusion, right? So with respect to the issue of inclusion, how would that color your outcome here? Mike, you had your hand up?
Yeah, so now because they burned the tax credits, they have to approve.
You have to include what's your authority?
It was,
451B. So the authors have changed this from the prior edition. They're saying, hey, there's a new rule in town. Question D, 2D. On December 15th of year 1, debtor legitimately disputes an obligation to pay year 1's interest, but debtor does pay it, and in year 2 sues to recover it. So when you get a deduction, when do you get a deduction? Annie, Francis, when do you get a deduction? And Nick, Julia, when do you have to include it? Francis, agree or disagree?
I agree.
You agree? If so, why?
Because, he is the debtor, so the debtor is the patron.
The debtor did, okay, but still disputes it, so doesn't that fly in the face of being able to accrue a deduction that you dispute? Annie, do you have any better authority? Manny, do you have authority? Anyone have authority that won't let me sleep easy at night? Let you sleep easy at night? Let the client sleep easy at night? To accrue a deduction? Because in the face of it, you might be uncomfortable because you're disputing it, and that seems to fly in the face of as an accrual method taxpayer being entitled to a deduction. Amanda?
461F.
Yeah, code section 461F. Let's take a look. See if the conditions are met here. Contested liabilities. If the taxpayer contests an asserted liability, the taxpayer transfers money or other property to provide for the satisfaction of the asserted liability. Right? That's what's going on here. Taxpayer is contesting. Taxpayer does transfer money. The contest with respect to the asserted liability exists after the time of the transfer. And but for the fact that the asserted liability is contested, a deduction would be allowed for the taxable year. Then the deduction shall be allowed. All right? So, in this case, the 461F, Francis, Annie, would permit a deduction in year 1. Right? Nick, Julia, when do you have to include it? Year 1 or year 2? Nick, agree?
Yeah, year 1.
What's your authority? Matt, any authority?
451.
Paul? Any better authority? Remember, the person receiving it is disputing the right that you have a right to it, but under North American Oil, right? You got unfettered use of funds, unfettered use, right? They're receiving this money, and someone's suing to recover it, but in the meantime, they could go to Atlantic City. Everyone agree? When they get paid this interest, there's no restrictions, right? It's not being held in escrow. So, year 1. Debtor pays year 1 $5,000 of interest in cash on January 2nd of year 2. So, cash being paid January 2nd of year 2. So, Tan and Kathy, when do you get a deduction? Or Jason, when do you have to include it?
I'll see year 2.
You get a deduction in year 2. Kathy, agree or disagree? You say year 1? Dang, who's right?
I'll take year 1.
And why?
The interest is applied for that period.
Right, there's been economic performance. It's got to be year 1. We're not a cash method. Do not follow the cash payment, right? Be careful. Sarah, Jason, when do you have to accrue an income? Sarah?
I think year 1.
Jason, agree? Yeah, year 1, right? Don't say it with a question mark. Question F. Debtor pays all 5 years, okay, big sport here. Debtor pays all 5 years of interest to lender in cash on December 31st of year 1. Okay. Or an individual, debtor's gonna pony up all the, prepay the interest, right? So, under those circumstances, Andrew, Nick, when do you get a deduction? Joe, Vikram, when do you include it? Andrew, Nick?
Okay, I'll take a hard guess. You can, as per the baseball example that I think I had mentioned before, you can deduct it for the first year.
But that deals with an inclusion issue.
Okay.
Be careful.
Okay, alright, so never mind. Deduction, you can deduct entirely, year 1.
Nick, you're great.
Yeah.
Okay, why? And other Nick, you're nodding. Nick, other Nick, lower tier Nick.
Say 5,000 a year if it's prepaid.
So you're saying not to deduct all 25,000.
No.
What's your authority? Like 461G?
Yeah.
Yes. You can't deduct prepaid interest, right, guys? Well, it's on a personal residence, right? Joe, Vikram, when do you have to include it? Joe, Vikram?
Year 1.
Joe, great.
Is it year 1 through 5?
Vikram, include all 25 or include 5?
You include like only 10,000 or
How much you include in year 1, Vikram?
all of it?
All of it.
All of it.
Leo, who's right?
I think you just include year 1 and it's 5,000.
Who's just include, and David, who's right? David?
Which one?
You.
I don't know.
Dan?
5,000 also.
Say again?
5,000.
Why?
451 was C4
What does 451C4 say?
for advance payment.
Angie, final word?
I think you have to include all the 25.
Authority?
I'm not sure if that would work, if when you record the entry, you have to record all the 25,000.
Oh, you have to include all 25 under North American Oil, unfettered use of the money, right, Mike? So year 1, and John, right, there's no symmetry here, right? Because one does one thing doesn't mean the other one has to do the exact same, to the contrary. One only gets to deduct 5, the other one has to include 25, right? All right, everyone good on that? Now, just to, who raised the point of 451C4? Was it?
Yeah, I don't think I read it properly.
If you did make an election, you might be able to elect to include 5,000 this year and 20,000 in year 2. That's the best you could do. So under this new election, under 451C4, you could possibly elect, okay, with this prepayment, to include an income 5,000 year 1 and 20,000 year 2. Okay? Okay, question 3. accrue a calendar year accrual method taxpayer runs a dance school offering lessons over 48 months. Last I checked, that's 4 years, right? With 1 lesson each month. No makeup lessons are offered, nor is the 48-month period extended for a participant who misses any scheduled lessons. The cost of lessons is $480 or $10 per lesson, which is required to be prepaid in January of year 1. Based on prior experience, accrues found that each lesson cost her $4 per person. Okay, so she charges 10 and it costs her 4. And on January 1st of year 1, 100 students sign up and pay for lessons, which commence on January 1. Assume accrued reports $12,000 of income, $10 per month per student, or 100 times, or $120. On the dance school's audited financial statement for year 1. Discuss accruals, tax consequences. Okay, so we've got to compute the income for accrue over this 4-year period. Everyone agree? We have year 1, year 2, year 3, and year 4. Now, in theory, right, each student pays her $480. Everyone agree? And there's 100 students, right? So if she's being paid $480 times 100 students, in total, how much is she going to receive? $48,000. Everyone agree? Now, what are her expenses, guys? What are her expenses? $4, right? That's for each lesson. Or $48 per year per student, right? $4, right, per student, times 12 months is $48, times 100. So her expenses, we know, are $4,800 per year, but she can't deduct that, right, until there's economic performance. Agreed? Everyone agree? The expenses are $4,800 per year. Now, the IRS could take the position, hey, you got $48,000 up front, North American Oil, you got to take it all into income in year 1. You get $4,800 worth of expenses, and then the next 3 years, you will report $4,800 of losses, right? So that's one option. Everyone agree? Under North American Oil, the IRS could argue, and would argue, that you got a $48,000 inclusion. Now, Dan, to get to your point, you can make an election here, okay? Under 451. Okay, you can make an election under 451C. C2. Under 451C2. To take the first year into income. In the first year, if you accrue it, she received $12,000, right? $10 per lesson, or $120 per student, times 100 or $12,000. And if you make this election, the best you can do now is to defer the balance of the payments, which in this case is $26,000, right? Excuse me, $36,000. thousand to year 2. So you would report $31,200. You would report 7,200, and you would report losses in years 3 and 4. And what's my authority? Election under, otherwise, if there's no election, you gotta take it all into income in year 1 under North American Oil, right? Take all 48,000 into income. Question 4. Discuss the consequences to the parties involved under the following alternatives. Widget Corporation, an accrual method taxpayer, orders $3,000 for the carpet cleaning from Mr. Carpet Cleaner, a cash basis taxpayer, on November 1st of year 1. Widget receives and pays for carpet cleaning on April 1st of year 2. Assuming both Widget and Mr. Carpet Cleaner are calendar year taxpayers. So just be careful, labels are important here, right? And Mr. Carpet Widget is an accrual method, carpet cleaner's cash method. And here we're talking about deductions, and carpet cleaner we're talking about inclusion. Right? So labels are important, right guys? So, what year can Widget Corporation take a deduction? What year can Widget take a deduction, and what year would Mr. Carpet Cleaner have income? Dean, Patrick, when do you get a deduction? And Elizabeth, when do you have inclusion?
You get the deduction in year 2.
Patrick, agree, disagree?
I'm gonna agree with Dane.
Why?
Because you can't approve that liability, there's no economic performance.
Right. It's not until year 2 that there's economic performance. Everyone agree? Even if you sign in the contract, the mere execution of a contract doesn't cause. Right? When do you have inclusion, Elizabeth? Nick?
Year 2.
Why?
Because the cash is received on April of year 2.
Nick, agree? Good. Question B. CNSA except Widget pays $3,000 over Mr. Carpet Cleaner on December 1st of year 1, but expects the carpet cleaning to be done on April 1st of year 2. So, John, Abbott, when do you get a deduction?
Year 2.
Abbott?
Think year 1.
Matt, who'd be right?
The deduction would be year 2,
Why?
because that's when the activity was performed.
Economic performance.
Yeah.
So you don't get a deduction until year 2.
two.
Why? And then, let me just, go ahead, explain it, Matt, G, just tell us, if you agree or not. Alvin?
I think that's when you receive the money.
Just say it.
Agreed.
What do you mean, Matt? I'm sorry?
It's when he receives the money.
What year?
In this example, year two.
When does he receive the money, guys?
Oh, sorry, I was looking at the wrong one. Year one.
Year one, be careful, be careful. Question C. Same as A, except carpet cleaning incurs on December 1st of year one. Okay, same as A, except carpet cleaning occurs on December 1st of year one. So in this case, Ron and Carla, when do you get deduction?
Year one for widget.
Why is that, Ron?
The economic performance changed from year
Carla,
two.
you agree?
Deduction, yeah.
Okay, year one. So when economic performance occurs. Okay, and when do you have inclusion? Mike, Vikram?
Year one.
Vikram, what do you say? Why? Joe, you agree? Yeah. That's right, Nick. Andrew?
I think it's year one, because that's when they receive.
If you look at problem C, when did he receive it?
Oh,
You too.
I see, okay.
It's year two, guys. I know it's a long Monday, but be careful, be careful. Question D. Question D. Same as A, except that you learned that widget had sales of $2 million and expenses of 1.5, and typically orders $3,000 worth of cleaning equipment every 10 months. Okay? So this is not a material item. Everyone agree? It's a pretty big company. Has $3,000 worth of cleaning expenses. When do you get a deduction? We're back to problem A. When you get a deduction, usually, right guys, it's when there's economic performance. However, look at 461H3. An exception for reoccurring items. The all events test has been met. Economic performance occurs within the short of a reasonable time, or 8.5 months after the close of the taxable year. Such item is reoccurring, and it's not a material item. We've met all 4 conditions. As a result, can we accrue a deduction in year 1? We don't have to meet the economic performance test, right? So we can. What's my authority? Code section 461H3. When do we have to include it? When does Mr. Corporate Cleaner have to include it? Well, here the answer wouldn't change, right? It would be year 2 because that's when he receives the cash. Question E. Same as D, except that widget doesn't receive payment, receive or pay for the carpet cleaning until October 1st. Right? Do we meet the test here? Do we meet the reoccurring test? And Dan, you're shaking your head. Why not?
It's not economic performance hasn't been.
Why not? Why? Well, we know that, but why doesn't it meet the reoccurring item test? What element component have we failed here?
I thought it was the economic performance piece.
Well, we knew that, but can we rely on code section 461H3 anymore? We just relied on it, and we got a year one deduction. Why can't we rely on it here? Mike?
Outside the 8.5 months.
We're outside the 8.5 months, right? So we don't meet the test, we're back to year 2. And the cash method guy, he doesn't receive the cash until year 2. All right, everyone good?
What is the last authority in the lesson?
It just is the economic performance test because the exception to the economic performance test is met. All right, last segment. Forced method of accounting. You guys know that certain instances when you have transactions with related taxpayers, I've already discussed with you that the code and Congress are careful, and sometimes when there's related party transactions, we saw it with respect to transactions with spouses, code section 1041, right? That they're not recognized. Why? Taxpayers would gain the system. And if you sell lost stock, for example, to a child, there's a code section 267 which says the loss is disallowed. Why? Because people who manipulate the system by selling to their son or daughter, and essentially that's their alter ego, right? And they could secure a loss, but even though they haven't given up the stock, right? So code section 267, certain transactions don't permit losses. Well, code section 267A2, code section, if you want to open it up, code section 267A2, requires certain matching of income and deductions. So code section 267A2 says if by reason of the method of accounting the person to whom the payments are to be made, the amount thereof is not includable in the gross income, and at the close of the taxable year, the taxpayer above for this paragraph will be deductible. In other words, you suspend deductions under code section 267 until the related party takes the money into income. Let me repeat that. Until a related party takes money into income, deductions are suspended. That's my authority is code section 267A2.
Could you repeat that one more time?
That you do not or cannot take money, you cannot take a deduction until a related party takes it into income. And we're going to see an example of this in a moment. All right, so if you're not quite sure if you see it, you do not or cannot secure a deduction until the related party takes it into income. Otherwise, what would happen is people would front load their deductions and defer inclusion. And the authors give us not only code section 267A2, there's another code section 467 that deals with rent holidays. And this is spelled out on page 648, or I should say at the bottom of 647, 648. For exam purposes, I'm not going to ask any questions about rent holidays, but it's just another illustration of sometimes how the code can force taxpayers onto certain accrual methods. So I just 267A2 is what I want to illustrate. Look at page 649. In each of the following circumstances, determine in what year the payer would be allowed a deduction, what year the paid would have to include the amount of income. So here we have A and B. Okay. And A is an accrual method taxpayer ordered to receive $500 for the janitorial supplies in year 1. from B, who's an unrelated taxpayer to A, and who is a cash method taxpayer. So, again, B is cash, A is accrual, and the question is deduction, inclusion. Okay? B was unrelated to A. Notice the word unrelated. And it was the cash method. The supplies are used in A's cleaning business. A makes the $500 payment to B sometime in year 2. Okay? When does A accrue the deduction? When does A accrue? Frank, Matt G? When does Frank? When does A accrue the deduction?
Year 1.
Frank, why?
I received it, so the economic performance is met.
Okay, year 1, economic performance, right? And Annie, Francis, when do you include it?
Year 1.
Annie? Ben, who's right?
Year 2.
Why?
B is a cash method.
Cash method, right? So it would be year 2. Everyone agree? Follow the cash method, unless an exception applies. Question B. Same except A and B are father and daughter. Well, father and daughter, is that one of the parties that Code Section 267A2? It says, if by reason of the method of accounting, it says, if you look at Code Section 267A2, capital letter B, it says, are persons specified in paragraphs subsection B. So they have to be members of the family, right? Our brother, in this case, is a father and daughter a member of a family? And the answer is yes, because if you look at C, Code Section 267, C, find it 267, C4, okay? It would include a father and a daughter, not surprisingly. So they are related parties. So in this case, what the code says, 267A2 says, is dad cannot get a deduction until daughter takes it into income, right? Isn't that what it's saying? Because they don't want dad to get an upfront deduction and his related party to be able to defer receipt, right? So what happens here? Because of Code Section 267A2, it would be year 2 and year 2, right? Everyone agree? That's what Code Section 267A2 is all about. That if it's a related party, you can't accrue a deduction before the related party takes it into income, right? Otherwise, maybe dad could get a deduction in year 1 and make the cash payment in year 5, right? Notice the mismatching. And here, John, to your point, now there should be symmetry when there's related parties in this context. But don't be too quick, John, to draw that conclusion, because let's look at the answer to C. What are the results in B above if A uses the cash method of accounting and B uses the accrual method? Well, if A uses the cash method, when does A secure a deduction? Year 2, right? Because that's when payment is made. Everyone agree? You get a deduction when payment is made. And when would B have to include it in income?
Year 1.
Year 1, right? Now, why doesn't Code Section 267A2 apply in this context? Is Congress concerned about this? No, because here, there's no need for congressional concern because the deduction, right, isn't until year 2, and the inclusion is in year 1. Congress is not losing sleep about this scenario, right? It's only worried about the other scenario, the reverse of this. Now, time doesn't afford us the luxury to just go through the entirety of question 2, but just by way of illustration, let's look at one or two of these questions. Question 2, determine whether code section 267A2 would apply in the following situations. X corporation, an accrual method taxpayer, leases a parcel of land from B, a cash method taxpayer. B owns 60 out of the total 100 shares of X corporation common stock issued and outstanding. X corporation has no other classes of stock. Well, in this case, would code section 267A2 apply? Are these related parties, guys, if you had to venture a guess?
Yes.
Yes, right? If you own 60% of a company, do we have authority for this? Sure we do. Look at code section 267B2. An individual in a corporation more than 50% of the value of outstanding stock which is owned directly or indirectly by or for such individual, right? Everyone see that? And no one's falling off their chair because we would anticipate this being related parties, right? And again, your antenna goes up anywhere you hear about related parties, right, guys? And I'm talking about the entirety of the code. There's usually very special rules with respect to related parties. We saw that with code section 1239. Question B, same as A, except that B owns 40 shares of X stock. S, B's spouse owns 15 shares, and the remaining shares are held by unrelated parties. Well, in this case, do you think that if you own 40% and your spouse owns another 15%, would you be considered related parties for purposes of code section 267A2? And the answer is, of course, yes. All right. So let me just make 3 or 4 quick points because otherwise we're going to run out of time, and that's not going to be good. So here's the gig, guys. This chapter, chapter 19, the most important thing you can do is, for exam purposes and outside of the exam, is think of this as 4 different quadrants, right? And I strongly recommend that you engage in properly labeled. You know, I can't tell you what method works for you, but bring maybe multicolored pens and highlight, is it a cash and accrual method? Is the question pertaining to an inclusion or deduction method? Because if you don't properly label and identify, it is not a good thing because you're going to apply possibly the wrong code section, right? That's not good for you, for me, or for our respective holidays, right? So see what you can do to make that happen. Bear in mind the exam itself is a cumulative exam, but largely on stuff we covered the second half. I will be around the entirety of this week. I try to be responsive to everyone's emails if you have questions. If, for whatever reason, you don't hear back, that's because somehow it's stuck in cyberspace. Do not be bashful. I will not be affronted. Resend your email. I check, even if I'm not in my office, I regularly check my voicemail 2, 3, 4 times a day. So even if I'm not here, leave a voicemail, and I'll get right back in touch with you if there's an issue. Final thing, if you have, and I think it should start happening as early as today, if not today, tomorrow, or Wednesday, many of you, or at least some of you, are new to Rutgers. There are teaching evaluations that in yesteryear I would distribute, and in yesteryear someone would collect and bring up to the registrar's office. That's yesteryear. Now, it's all done electronically, and if you have 2 minutes, if you can kindly fill out the questionnaire, that would be great. If you have any suggestions or pointers, there's opportunities there. And over the years, I generally do try to reconfigure my course based on what students' comments and suggestions are. All right, so wish you a lot of luck studying.